Michael Saylor, Amerikalı bir girişimci, yönetici ve 1989 yılında kurulan halka açık bir iş zekası firması olan MicroStrategy'nin kurucu ortağı ve icra komitesi başkanıdır. Hoş geldiniz. Bu ilgi çekici röportajdan aldığımız kesitlerle bu bölümde spot Bitcoin ETF'lerinin farklılıklarını, MicroStrategy gibi Bitcoin alanında öncü bir şirketin benimsediği benzersiz stratejileri ve Bitcoin madencilerinin karmaşık dünyasını anlamaya çalışacağız.
Here you maybe talk about the difference between what currently exists, a futures ETF. There's GBTC that a lot of people hold. There are a lot of questions with because of the Grayscale lawsuit, but that was for some the first way to invest in Bitcoin for their retirement. There's MicroStrategy, and then there's this theoretical spot Bitcoin ETF. Can you maybe break down the differences in these investments?
Sure. Well, let's start with the base layer, Bitcoin. So Bitcoin itself it's the pure asset, and it's the atomic level asset. So the value is it's the pure commodity when the asset without an issuer, and the most global, most timeless asset with the most optionality and the least counterparty risk. Theoretically no counterparty risk, but unless you worry about like some core dev campaigning to change the protocol, but fairly it's the global standard for a digital commodity. What are the challenges? The challenges are you can't finance it. So if you want to buy it, you have to actually establish a new relationship with the crypto exchange. You have to put cash up front, and so that could be a scary proposition. It would take a typical investor a year to vet a new exchange partner, and then they would have to change their charter, has different tax consequences. Sometimes they're not allowed to buy property or a commodity asset. They can only buy security. So it's a different type of asset with a different purchase channel. And then you have to come up with a custodian that you trust, or you have to come up with a custody protocol. So if you're a pension fund, the issue is which of the people in the pension fund get the private keys? Is it one person, three people, or do you trust a custodian? You'll probably have to choose an institutional custodian. So choosing an exchange and choosing a custodian, changing your charter, and vetting everything, that's going to take you a year. And then after you do it, if you want to buy $1 million worth of Bitcoin, you have to have $1 million in cash. So that's the challenge. The advantage is you can hold it forever and you can transfer it to other counterparties without a taxable event. After you've owned the Bitcoin. So if you're going to hold it for 100 years and you're really focused, then you want to own the asset, the pure asset. But if you're an agency, an endowment, an institution, a corporation, they typically want to be able to use their existing bank, and they want to be able to use, and they want the bank to be the custodian, or they want the money manager to be the custodian, and they don't want to pay money. I mean, they want it on credit, right? So coming back to the home buyer, really, you just want to buy the house and get the bank to give you 100% mortgage, right? That makes it easy. So a spot ETF would be the ability to buy that asset, and you buy it through your existing bank, like Bank of America or JP Morgan or the like, and you buy it for almost no transaction fee. If you can get effectively a 5 or 10 basis point transaction fee or less in the ETF, you would buy it instantly. Instead of taking a year, you could do it in a minute. And instead of coming up with $1 million, you would just ask the bank to give you the $1 million of financing at 5% interest. So the bank will forward you the cash. It's like buying it instantly, no money down. And then you don't have to change your charter. You don't have to adopt or trust a new exchange. You don't have to trust a new custodian. Most of these institutions, Natalie, if I were to say they've been doing business with the same bank or the same investment company for 20 years, that would be short. Most of them have been doing business with the same investment company for 40 years or 50 years. But 40 years is not unreasonable. So you're talking about a publicly traded company, Apple, Amazon, Microsoft, Google. They've got relationships since they were founded, and they could buy $1 billion of Bitcoin in a minute, no money down, on a phone call. And no one would say a second thought if it comes through a spot ETF. But if they were to say, I want to buy $1 billion of Bitcoin, the commodity, they would need to have 16 board meetings, 100 lawyers and accountants review it. They would have to go through all sorts of contortions. They would have to dedicate a team of 5 people. They would have to draft 1,000 pages of operating procedures. There would be endless debate, and they would have to come up with $1 billion of cash, right? So the difference between Bitcoin and the spot ETF is profound for the institution. Now, the spot ETF is 1-to-1 leverage. You put $1 million in and you got $1 million of Bitcoin, and it's probably a fee anywhere from 50 to 100 basis points. So that means that every year you're going to pay up to 1% of your assets in order to hold that position. So what that means is over an indefinite time period, that means that 20% of your assets go to the trustee or the operator of the ETF or the money manager. So when you buy the Bitcoin directly, you might be able to get in size, if you used a custodian, you might be able to get to 5 basis points a year of a custody fee. And, at $1 billion or more. If you're a spot ETF, 50 basis points would be the cheapest. So 5 basis points times 20 means that if I buy $100 million of this, I pay $1 million in custody fees over the lifetime of the asset. And on the other hand, at 50 basis points, then when you buy $100 million of it, you have to multiply that by 20. And that means over the course of the duration, you pay $10 million, right? Instead of $1 million. So it's more expensive to go through that operator. Now, if you go to the idea of the other advantage of having the ETF is there will be an options market and a put and call options market, and that means that you can sell volatility and generate yield of some sort by giving up upside, or you can hedge downside. It's not a strong options market, but it is an options market. Mm-hmm. Now go to the futures ETF. The futures ETF is probably double the cost of the spot ETF. And so now you're talking about, instead of paying 10 million over the course, you're paying $20 million, right? So you've gone from 1 million to 10 million to $20 million in manager fees. So it's gotten more expensive, but that's not the big cost. The big cost is you have $100 million invested and you lose 20% performance. So you've lost 20 million a year for 5 years, and you're losing all 100 million over 5 years. So
it's underperformed. Yeah.
If you want to use a snarky phrase, right, you would say the spot ETF is like you bought the beautiful house across the street and the bank financed it all. But the futures ETF is you bought the same house, but it's on a lot with a sinkhole, and the entire thing's going to sink into the sinkhole in 5 years. And it's collapsing. So you can see you don't really want to make your financial foundation on sinking sand. And that's what the futures are right now. And there's no reason to think it's going to change. We don't see it. So then you go to Grayscale. Grayscale is it's a closed-end trust or a closed-end fund, which means that they're unable to sell the Bitcoin to buy their own shares. If you were in a true ETF, if the net asset value gets out of whack with the share price, then you sell the Bitcoin to buy the share, and otherwise you sell the share to buy the Bitcoin, but you're keeping sort of a one-to-one, arrangement. But with a closed-end fund, you can actually trade at a discount.
Right.
And you could trade at a premium, which is not a problem. But when you trade at a discount, the problem is there's no mechanism for the management team to arbitrage out the discount. They're not an operating company, so they can't take on leverage and they can't really buy and sell their shares, easily. It's a one-way thing. So the GBTC in particular had a 2.5% fee, but then when it trades at a 25% discount, that starts to look like a 3.25 or 3.5% fee annually. So now you're at 350 basis points, but 350 basis points forever times 20 means that 70% of your assets are being eaten by the fee over the course of 20 years, right? So that just gets extremely expensive, right? And there's just a lot of uncertainty about how that gets cleared. So
do you think it'll be converted into the spot ETF? Do you think they'll win the lawsuit?
I do think it'll be converted. I'm not so sure they'll win the lawsuit. Legal actions are very uncertain. You could be 100% right and you're 50% likely to win. So you could be. Sometimes people are 100% wrong. It seems to me, and they're still 30% likely to win. And it's very difficult to find a universal objective arbiter of right and wrong. So generally, what happens is you spend 5 to 10 years spending a huge amount of money going back and forth with a series of motions and appeals, and you settle 10 or 20% of the matter, and eventually everybody just gets so tired of the litigation that they settle it somehow. So I think that that the regulatory action on the part of the regulators and political pressure will resolve the issue before the court system resolves the issue. But that's just my opinion. Even if they won the lawsuit, there are so many grounds for the regulators to appeal it, to stall and delay, or bring up other issues. That it seems to me that it's very challenging there. So what I think though is there's a lot of political pressure and a lot of momentum to approve a spot ETF. And it's going to be very difficult for the regulators to approve one, but not the rest.
Right.
That'll be an interesting political football, how they do that. The ideal thing, the right thing to do would be to approve them all at the same time. But the next best thing to do would be to approve them sequentially as the action comes due. It's going to be pretty difficult to defend approving some and not others unless you can point to a lack of confidence in the management team or some other mitigating factor that would imply that you should deny it in order to protect investors. But in this particular case, denying Grayscale's conversion wouldn't be protecting investors if it results in a perpetual lingering discount to net asset value. So I would think that their fate is the same as all the other spot ETF fates, and so that's that. Now so we've worked our way through Bitcoin, the spot ETF, the futures ETF. Then you've got MicroStrategy and you've got Bitcoin miners. MicroStrategy's a levered Bitcoin operating company. So on one hand, we have an operating business with exposure to business intelligence and artificial intelligence. It's a $500 million business that's a cash generator. So that business is diversified, and it's just a diversified enterprise software company generating cash flow. But it's an operating company. It's as opposed to an SEC 40 financial company. And the difference, it's a very important distinction, is an operating company can take on leverage. Like an operating company can issue $1 billion of bonds at 0% interest. And that's what we did. Or an operating company can issue a $650 million convertible bond at 75 basis points of interest. And we did that. You couldn't do that with trust. You couldn't do it with like an ETF, right? They're just not allowed. They can't go and they can't pledge or hypothecate or borrow against the underlying assets. So because MicroStrategy can do it, we are able to raise $2.2 billion of capital or debt capital at a blended interest rate of 1.6%. And let's say 1.7 billion of it is convert, which means it's not secured against anything. Like there's no recourse. So to the extent that we issue convertible bonds that are backed by the stock of the company and people believe the stock is valuable because it's backed by Bitcoin, we're in essence borrowing against Bitcoin, but we're not pledging the Bitcoin. So we don't have to pledge the asset. There's no margin call risk. There's no mark to market risk. So that means that we can go and borrow money at a low interest rate at a long duration. Like we could borrow money for 5 years at 1% interest or 2% interest, and not pledge any assets and then invest in Bitcoin. So we're fairly unique in that regard. There really isn't another company that has issued convertible debt, senior secured debt, or equity to buy Bitcoin with it. So we're a levered long Bitcoin company, and we don't charge a fee. So although we custody $4.6 billion of Bitcoin, right, 1% fee would be a $46 million a year bill, but we don't charge the fee. We generate a yield, right? We generate the yield by generating cash in the enterprise software business and buying Bitcoin with it. And we generate a yield by doing accretive financings of equity or debt. And so all of those are different levers we have, and we can leverage, deleverage, we can issue debt, we can retire the debt, we can issue equity, we could buy the equity back if we wanted to. We could sell Bitcoin, we could buy Bitcoin, right? We have all options. We're an operating company. And the price we pay is we have to make lots of disclosures, right? So you see there's 200 pages in our latest 10Q. So hundreds and hundreds of pages of 10Qs, 10Ks, 8Ks, where we are, if you want to know all the details of our debt instruments that we issue, you can read them all. If you want to read a 100-page prospectus on the risk factors of the equity we're going to sell, you can read it all. So we've constructed an operating company, and our strategy is we don't charge a fee. We find a way to generate a yield for our shareholders, and then we use a little bit of leverage, responsible leverage, and that would allow us to outperform Bitcoin if we do that well. And that being the case, like if you hypothetically generated a 2% yield instead of charging a 50 basis point fee, right, then you could look at that and say, well, getting paid 2% forever versus paying 0.5% forever is like a 50% difference. So you can generate a premium against the underlying assets by actually intelligent leverage or yield, and we can tap into the volatility of our stock and a Bitcoin in order to make that financing cheaper. The reason that our debt is not, the industry standard 7-8% is because we've got a lot of convertible debt, and we're able to borrow money with convertibles much cheaper, like 0% interest, because the people that are buying those bonds want to be able to trade the volatility. They want to arbitrage the volatility, right. And so they'll give us the debt cheap. So these are all arrows on our quiver. The positive is we can actively manage the business. The difference between us and a spot ETF, though, is like if someone wanted to buy $10 billion of MicroStrategy stock, it would distort the price and the ratios. And so there's not enough room in the capital structure to do that. But if you wanted to buy $10 billion of Bitcoin through a spot ETF, they would take your $10 billion and then they would buy the $10 billion of Bitcoin, and then the relationship of net asset value to the stock would be 1-to-1. So you can put infinite capital into a spot ETF. You can put $100 billion into it. there isn't that much room in the capital structure of MicroStrategy to put in that kind of money, right? We're a special purpose vehicle, and for a certain number of shareholders, we can actually give them a differentiated offering. When our capital structure gets too crowded, then our premiums against net asset value will get to a point where people will decide they would rather buy the underlying asset. So we're unique. And that just leaves us with the Bitcoin miners. And, what you would say about the miners is that they have extreme leverage to the upside when Bitcoin is good because their revenues go north, their balance sheets go north. And they have extreme leverage to the downside when Bitcoin goes the opposite way.
Right.
And so they're sort of extreme levered plays, right? And they have a business with exposure to electricity, and then there's execution risk and there's competition. So you would have to analyze each one of those individually, and it requires a very sophisticated and a different model, right? And at the end of the day, they all appeal to a different type of investor. MicroStrategy appeals to, for example, convertible arbitrageurs. There are people that have large pools of capital, but they're only allowed to buy convertible debt. If you don't create convertible debt, they can't invest in you, right? There are people that can only buy NASDAQ traded equity, right? There are people that want to trade options. So ultimately, instead of saying, well, there's only one right way to do it, right? That's kind of an exclusionary view. I think a more expansive view is there's a lot of ways to do it, and the world needs a lot of different ways to do it. I mean, in China, if they want to embrace Bitcoin, they need securities and assets to trade on regulated Chinese exchanges, right? And in every other country on earth, they're going to need all sorts of local assets and local on-ramps, and the laws are going to change, and the custom is going to change, and the needs are going to change as a function of jurisdiction, and they'll change as a function of institution or investor type. And so the beauty of Bitcoin is people can do 100,000 different things with it at the same time, and you can think that the other person is doing it in a stupid way, and if it's true, then they're going to lose their Bitcoin, and that'll solve that problem. I mean, if you loaned your Bitcoin to FTX or to Celsius, that was unfortunate and tragic, but you lost your Bitcoin. And I guess that's the market's way of saying don't trust people like Celsius and FTX, right? But it is the market. The market is going to be lots of people doing things that you don't understand. Some of them will look scary. Some of them will look stupid. Some of them will look brilliant. Some of them will look brilliant, but not for you. Right? It's totally reasonable that 85-year-old blind person would want to buy Bitcoin through JP Morgan. But it's totally reasonable that 35-year-old not blind person who's computer whiz would not. And so I think the idea is live and let live. Let everything develop. The economy is going to grow at the fastest rate if it has the least number of constraints. And someone is going to do something that you didn't figure out or you don't understand, but it's going to be good for Bitcoin and it's going to be good for you. And so I think the best thing we can do is just relax and let the market do its thing, because 8 billion people and 100 million companies have needs and desires and talents, and constraints that you don't understand.